defending the free market, and making the moral case for capitalism. The Justin Moore Show. Hey everybody, welcome to the Justin Moore Show, where we make sense of what's going on in this crazy, insane, out of control world. And you know what? Speaking of which, we just had Black Friday, okay? And I'm just looking at some headlines here. We have some people were shot. You know, we had 2 people shot outside of a New Jersey mall. We had over in Reno, Nevada, a Walmart customer was gunned down, and it says during a fight over a parking lot spot just after the doors were opened. And then we have a guy in Tennessee. He was shot Thursday at a Memphis mall while shoppers were taking part in their early Black Friday sales. I mean, yeah, exactly. This is why I say in the beginning of my show now. I just started doing this a few episodes ago. This where we make sense of what's going on in this crazy, insane, out of control world, because it is out of control. You know, every Black Friday, people are always stampeding each other. People get shot. People to go crazy over whatever. It used to be Beanie Babies back in the 2000s, and it used to be Furbies. It's always the flat screen TVs now. It's always something. And then I came across this, and I had to laugh. This is from the New York Post. This is just one sentence. And it's like one of the stupidest sentences I've ever read. It's like, what? It doesn't even make any sense. Here, let me just read it to you. The dead man, who was shot multiple times, was pronounced dead at the scene. The dead man was pronounced dead at the scene. Oh, okay, nice. Dang, I mean, I'm not an English professional here, but that is a pretty screwed up sentence coming from some guy who probably majored in journalism, and he's working for the New York Post. So... oh, that just cracked me up. The dead man who was shot multiple times was pronounced dead at the scene. It's just like when I referred to you guys, this is several episodes ago now. I don't even remember which one it was, where there was that article from CNN talking about the Cecil the Lion, or Sissel, whatever it is. And they said, Cecil the Lion's brother, Jericho, who was also a lion. It's the exact same sort of thing. So here's the dead man who was pronounced dead at the scene. So the craziness just continues. And heck, in the economy here, the markets are still going strong. The Dow Jones right now is over 19,000 for the first time ever. So the markets continue to rally. They're optimistic about this Trump presidency. But there are some people who are concerned out there. Some people who fear that we are in a deflationary death trap. And that's actually what I want to focus on today. I stumbled across this piece, and this is from the Business Insider. And this is giving you guys a look at someone who sees things differently than we do. And I want to kind of react to what this guy has to say. And so let me just start with this piece here. I have, several paragraphs I'll be reading from here. But, first off here, I'll just be reading just a few to get started here, and then we'll react. So here we start off here. With the world gripped in a deep deflationary trap and seemingly no clear way out, former UK Financial Services Authority Chief Lord Turner is advocating a policy of debt monetization, with central banks financing major fiscal deficits. Lord Adair Turner actually took up his post at the Financial Services Authority just 5 days after the collapse of Lehman Brothers, so was immediately thrust into the process of attempting to shore up the UK banking system. As chair of the Major Policy Committee of the Financial Stability Board, he was closely involved in re-regulating the global economy and believes the banking system is now much safer and won't face another crisis along the lines of 2008. What he is concerned about, however, as he explained in an interview with Real Vision TV this week, is the level of public and private debt in the global economy, which is higher than ever and continually growing. Speaking to Real Vision, Lord Turner said with interest rates close to zero or negative in some countries, it just creates more incentive for people to create more debt. Okay. Lord, what's his name? What's this guy's name? Lord Turner. Are you kidding me now? Come on. Yeah, no kidding. When you have rates at near 0% or you have negative interest rates, yes, that encourages people to create more debt. But from the Keynesian perspective, This is exactly what they want. This is why they drop interest rates to near zero. Because if you have them that low, that encourages people to go out and spend. You get the consumers out there to spend. You get these Black Friday shoppers out there in those long lines trying to get a screaming deal on this piece of crap television you don't even know the dang name to. You're like, well, what? You don't even know what it is. You don't know the brand. You've never heard of it before. And it's probably a TV that's not going to last very long anyway. And is actually, with these Black Friday deals, they specifically make items to sell for Black Friday. They're ones that could be, computers. Okay, yeah, we don't have a CD drive on this one. Oh, no, this one doesn't have USBs. It's got something that's like, oh, crap, I kind of want that. Or, like a lot of these, laptops today, they got Bluetooth. Oh, no, this one doesn't have the Bluetooth option. They have something that's not quite right about them, so that's why they're trying to get rid of them, Or, yeah, I guess here's the big thing. These stores want to create this cheap product but severely discount it. So that it encourages people to come to the store. It creates this sort of madness, and it's it's kind of a publicity sort of thing, and it gets people, it's like this bandwagon effect, and this idea of scarcity that people use in marketing. All that sort of stuff comes into play, and that's kind of what adds to this Black Friday madness. Which I have to be honest, I used to be part of the Black Friday madness. Oh yeah, it's true. I have. Back when I was, a lot younger, still in junior high, high school, me and my two siblings, for sure me and my sister and my mom, we'd go wait in line at the mall, so we could get our little snow globes, and everybody the first 500 people through the door, they got $5 gift certificates, so yeah, we waited in line, but they offered us free hot chocolate as we waited in line, getting to talk with nearby shoppers. Oh, yeah, just a fantastic, fantastic time. I mean, back in the day when I was younger, it was pretty fun to do it. And I remember just swinging into some of these stores. I think it was like Shopko. One year they had these, I don't know what the heck it was, like these little doll things you got free. I think they made sounds when you squeezed them. I can't remember. I think we still have them in one of a tub somewhere. But just like we'd get all these little things, and then like, oh man, waiting outside of Best Buy. Holy crap, that place was always just packed. There'd be people showing up around, midnight, and the store would open at 5 a.m. And it was just complete madness because there's good deals on flash drives or this certain laptop or these flat screen TVs, and people just couldn't pass them up. Screw it. No, not anymore. I am not going to do that. And I remember one year I just couldn't stop laughing because I didn't know what the hell was going on. Here I am waiting in line. My cousin, he had gotten to Best Buy like at 3 a.m. And, I showed up like, I don't know, 4:30. And somehow, and I knew my mom was there too. Actually, I think she arrived with me, something like that. But anyway, she disappeared for a little bit. And as I'm about to come to the doors of Best Buy, here comes my mom. She's coming out of the store pushing a TV. And then there's my cousin. And I'm like looking both ways like, what is going on? How did my mom, what the hell? I'm just coming through the doors and she's already carrying out a TV. Well, turns out she ran into my cousin who'd got there earlier, and she was helping him haul out his TV and stuff, which actually, so that's just part of this Black Friday madness. And actually that year, when my mom, she was like pushing the one box through the entrance of the store at Best Buy, I'm like, okay, I'll just go help, whatever. So I picked up the box and I had it on my shoulder, and I actually made the Billings Gazette, and there's a picture of me with a TV over my shoulder like I'm one of these guys, going out and buying these. Oh gosh, I tell you. I was in college back then, actually. Just come to think of it. Enough of this Black Friday madness. Actually, no, wait. One more thing. I happened to see this. It was by this video done by Mark Dice. You can just look this up on YouTube. It is actually funny as hell. He's like some sort of news reporter, or he does something in terms of media. He has some sort of show and some sort of commentator. And he had a bullhorn, and he's driving by these stores as people are lined up. And he's like calling them zombies and, oh yeah, you're just trying to save a couple bucks on a TV and this and that. He's like, and you poor bastards don't realize you could buy these same things on Amazon, blah, blah, blah. I mean, it is funny. So you guys need to go check that out. Just type in Mark Dice, Black Friday zombies. Type in something like that. I'm sure it'll be the first video to pop up. But anyway, getting back to this article here. So with the Keynesian idea of these, if you have low interest rates, that encourages people to go out and spend money, to get out there. And that's the Keynesian idea is, we just don't have enough aggregate demand. If you can get enough aggregate demand out there, well, then, of course, that's going to help businesses, and that's going to help create jobs, and that's going to trickle through the economy, and everything's going to be, sunshine and lollipops. That's the Keynesian idea. But that's not how things work in real life. I mean, you should never worry about aggregate demand ever, because it's like you and I, we're on an island together, and you want to trade with me. I have pineapples, and you produce and you knit together sweaters. This obviously must be a very cold island if you're trying to make sweaters. But let's just continue on with this example here. Hey, I want your sweaters, but I can trade with my pineapples. But here's the thing, and this is the Keynesian idea is, well, no, you just got to have aggregate demand. Well, you can demand my pineapples all you want, but if you have nothing to trade with me, I don't give a crap how much you demand from me. It doesn't matter. You better have something to trade first. So that's why it comes back to the supply side, in that you must produce in order to consume. If you want to take my pineapples from me, then you better produce something first if you want to trade with me. And so that's how things really work. But no, the Keynesians they really haven't figured that out yet. But and unfortunately, I wish the Keynesians, they were some minor school that no one really gave a crap what they cared about. But unfortunately, the Keynesians dominate everything. Paul Krugman, whatever you want to call him, at the New York Times, and all the former presidents, basically the last couple decades, were all Keynesians. We can't get away from these guys, which, who knows? And with a Trump administration, Trump definitely, his arguments sound very Keynesian. He has said some anti-Fed comments, and Trump has made some comments about, a big giant bubble in the economy, which is an Austrian view of it, but I think he's just kind of saying that in passing, sort of, just talking about how screwed up things are, just that's how Trump is. Oh yeah, things are rigged. I'm behind in the polls. Oh wait, I won. No, things are not rigged. Everything is fine. Oh gosh, I tell you. But anyway, let me just continue on with this article here. Now, it gets a little more interesting here. So, you're caught in a trap where the only solution to the trap is to make the trap a bit deeper. It really is. When you're in a hole, you're still digging, Turner said. So that is, I think, the fundamental problem facing the global economy, and why, having just come back from the IMF meetings in D.C., why the IMF has, for about the fifth year in a row, reduced its forecast of global economic growth. We are in a deeply profound deflationary trap, and we don't have perfect answers to get out of it. And, what this guy's bringing up here with this deflationary trap, this is, a lot of people like to bring up the example Japan. Now, Japan's been stuck in this rut for years. They've done money printing after money printing, and hey, they haven't had inflation there. But of course, over in Japan, they're a very old population right now. Those are guys who have, they've had, savings built up. They've had a very high savings rate in Japan, and they've essentially, thanks to the government, they're pissing away people's savings. Because of course, when the government spends in the place of you spending, that's taking away your wealth, and that's what's been happening over in Japan. So thankfully, they've had the savings to take away first, but yeah, they haven't had their comeuppance yet. But they have a debt to GDP ratio of 250% over there, and a lot of these people have this idea that if you can't prop up aggregate demand, if you don't address that issue, then you're going to end up in this deflationary death spiral. And you can't get out of it, and people argue, the Keynesians in particular, say like that's what happened during the Great Depression. Prices kept coming down, but a deflationary death spiral can't happen. I mean, in a free market like I want, or if you had a gold standard, you had a free money that wasn't manipulated by the government. You let interest rates freely fluctuate in the economy and didn't have a Federal Reserve. There would be a natural sort of deflation taking place. Prices would come down, just like prices come down for TVs every single year. iPads get cheaper. All your sort of electronic devices get cheaper. They get better, faster. That's how it works. And do you see yourself not buying any electronics? Look at these guys at Black Friday. Every year they're out buying flat screen TVs. They keep getting cheaper. If the Black Friday deal this year, where people are lined up out the door for, if they just waited 6 months, they could buy that TV without any lines, right? So that's why this aggregate demand thing doesn't make any sense at all. People, as a people in general, we are always demanding things. We always want to buy things. How many of your friends out there actually, they don't spend money? Like they don't, we always want things, but do we really need it? But it's hard to actually save money and to be, conservative with your money. It really is. The easy thing to do is to go out and spend it and to live above your means. And that's what the average American does. And our savings rate in this country has gotten lower and lower and lower. And then we have a vast majority of people out there don't have $1,000 to their name where they couldn't cover, an emergency. $1,000 emergency. Well, dang, there's a lot of things that cost $1,000. Anything happens to your car, there's $1,000 easily. But okay, and then in this article here, I found this to be very interesting, how he gets into the concept of, what money is. And I want to address this. This is what he says. And although people often don't think about this, what money is, ultimately, is a perpetual non-interest bearing bond. That's what money is. It's due from the government, which they never have to repay. Okay, I really need to address what he has to say here. I think his view of money is extremely distorted. And especially how he puts it in what I just read. He's putting the government at the core of what makes money and why money exists in the first place. That, you need to have government and then you'll have money. And without government, there wouldn't be a money. That is not true at all. And for me to define money is simply, it's a medium of exchange. It's a store of value. When goods are priced in a common money, it makes it easier so that you can engage in exchange, and it's what makes it easier to exchange and engage in commerce with one another, right? If you didn't have money, we'd be on a barter system. And barter is, I've addressed this on my show before, barter is extremely inefficient. If you're operating a business and all you had was barter, how could you figure out what your profit was at your business? It's like, well, hey, at the end of the year here, I ended up with 10,000 oranges. Well, what the hell does that get you? Well, let's see, 10,000 oranges will buy you, 7,000 bananas. You don't know what the hell you got. It's like, oh, hey, you can buy whatever. So, barter, in the economy that we have today in the United States, this very complex system, this economy with just so much going on, we couldn't have this economy today if we just had barter. You need to have a form of money, and money doesn't need government at all. Actually, it's government that gets in the way of a good money, because in a free market. And I've made this example before. I like to think of it as, okay, what will become money in a free market? Well, it's like the March Madness, the college basketball tournament, where it starts with 64 teams. Then at the very end of it, after a few weeks, there's only one winner. And through history, the winner has been gold and silver, and particularly gold. A silver is really the sister metal to gold. And the reason why gold and silver are money is because they fit the requirements that make money, that make it valuable as a money. How it's durable, it's malleable, it's easily divisible, it doesn't varnish. Gold doesn't varnish compared to silver. Its primary use is for its use as a money and not as a industrial commodity. And so its supply is very fixed. All of that is beneficial for gold being a money. And prices, and that's why a lot of people argue, especially from the Austrian perspective, that when you see the gold price, go up or down, well, really, that's not the gold price that's volatile, but it's the dollar that's fluctuating. Because if the dollar gets stronger, well, now your dollar can buy more gold, so actually the gold price will have to drop, and it works in the reverse order as well. But I guess on my show here, I do make the shorthand version saying that gold is going up and down. But I want to make that distinction. It really does come down to it's the dollar that's fluctuating in value. It's not gold. because gold is one of the most stable goods out there. But anyway, let me just move on here to the next quote. Oh, and I found this. What I'm going to read here, this next paragraph, this is very interesting and very telling. Okay, and it says, I think we're stuck in a very difficult position, he adds. The central banks treat monetization as the great taboo. And at one level, it's understandable why they do that. I think, until very recently, the central bankers have wanted to believe that they don't need to go down that route because these other tools, like very low and negative interest rates and quantitative easing, are going to work. But what has really happened over the last 6 months all the way around the world is an increasing worry that those tools, and in particular, negative interest rates, don't work. And this is very interesting that this guy says this because, and I tend to agree with him, that I do believe that the central bankers, they thought having interest rates near 0% for all this time, since 2008, interest rates have been near zero or at 0%. And they've had money printing, from the likes of QE1, QE2, QE3 that started in 2008 in response to what was going on in the economy with the housing crisis. I think the central bankers, like Ben Bernanke, Janet Yellen, they thought this would all work and that the economy would be booming by right now. But here it is. It's been 8 years of these policies. It hasn't worked. Our economy is still slugging along. Okay, sure, the market has just recently taken off, but this is all mostly due to the people viewing the future of a Trump presidency and that he's going to actually react on the fiscal side of things, which the Democrats haven't done, for these last 8 years because Obama's been in office, and the last thing Obama wants to do is, lower people's taxes, which is good for the economy, that sort of thing. But this optimism, yeah, it really is just, it comes down to the people just getting all, starry-eyed over this Trump presidency. And I really think, once he does get into office, it's not going to be that. People will be a little bit more realistic. Oh, I guess he can't really do as much as he can. Okay, yeah, he still has to deal with the Democrats. They have to work with them, and you have to have a compromise bill. So there is going to be increases in government spending. The tax cuts, maybe they're going to be mostly moderate. It's not like it's going to be game changing. So I think the markets will eventually come back to reality here. But for right now, man, they are very optimistic about the future. In regards to these central bankers and what this guy was saying here, look, so these central bankers thought that these policies would work, but look, they haven't worked. And now look, we have interest rates. Okay, sure, they're not at zero, but the interest rates right now are between 1/4 and 0.5%. So they're still basically at zero. And it was back in September when Janet Yellen had her meeting, and I was making the comments about what Janet Yellen said, and I was reading between the lines how she was saying, hey, look, we still have plenty of tools in our toolkit that we can use to combat the next recession. Okay, what are we going to do? Okay, yeah, they could cut interest rates 0.25%. Ooh, and they'll be back to zero where they were. But I think she did in that speech. Go back and listen to my show from September if you haven't heard it. That Janet Yellen did open the door to negative interest rates. So I do see negative interest rates coming here to the United States. And I do think the Federal Reserve will raise interest rates in December. And I said that months ago as well. Unless something major happens in the global economy, then Janet Yellen has to say, oh, wait, okay, oh my gosh, we were just going to raise interest rates, but then this happened. Okay, we can't do it. But besides that, some big event, the Fed will raise interest rates. And I heard someone say it, and I can't remember who it was, that basically, and it's been something I've been saying all along, that, hey, look, the Fed has to raise interest rates because they have to maintain their credibility. That's been my whole reasoning for why the Federal Reserve has raised interest rates last December and this December. It's the whole basis of their argument. It has nothing to do with the data whatsoever. Nothing. It's all about maintaining credibility when we have a fiat currency, a currency backed by faith and nothing else. That's what it comes down to. And my analysis there has been spot on. But that doesn't. No, and please don't misunderstand me here. I'm not thinking, oh my gosh, Justin thinks he's so great. Look at what he. No, I'm not saying that. That was just a really obvious thing. It's amazing. Not many people picked up on that. But anyway, I do see, yes, negative interest rates coming here. There is going to be more money printing. There will be a QE4. It's going to be the largest money printing scheme ever devised in the United States of America. And here at this point in time, We see gold. It's continued to sell off. It's in a downtrend. Gold is sitting right now at $1,184 an ounce. Silver is at $16.50 an ounce. And this is all when we could be on the verge of negative interest rates, really talk about the easiest money we've ever had in the United States, and a lot more money printing coming our way. So you tell me, with more money printing coming our way and negative interest rates, should gold go up or should it go down from where it's at right now? I would argue it'll go up. So I guess, we'll have to wait and see there. And just keep in mind here, I really do think that we are very close to the end of this dollar rally. It's right now we're just repeating exactly what happened last year at this time, when it's everything was, the dollar was rallying, gold was falling as the Fed ended up raising interest rates in December, and actually gold continued to fall for about another 2 weeks after that meeting. But then from there it turned around. And from my own personal stock portfolio, from January of 2016 to July, my portfolio increased 288%. And so look, I think we're set up again for that to happen with gold. So if you want to hop on the bandwagon and take advantage of this, I think that's what's going to happen. Now, look, I don't have a crystal ball, but based on everything I'm seeing right now, that's what I'm thinking is going to happen. And just keep this in mind too. The people who make a killing in the markets, and it's the obvious thing, buy low, sell high. And it's like what Warren Buffett said, to be greedy when others are fearful, and to be fearful when others are greedy. Well, right now, everybody is basically greedy, thinking that with the dollar getting stronger, the market's going up, that's where you should be. With gold falling, you should get away from gold. No, I think gold is where you should be at this point in time. Now, please, you got to, adjust your portfolio accordingly. Don't go all in, but from what I see with things going on, that's what I see happening. And I guess, hey, on my show 6 months from now, we'll be able to reflect back and say, hey, was my call right or was it way the hell wrong? I guess we'll find out and see. Anyway, guys, that's all I have for you guys today. If you guys want my 2 stock recommendations I give, if you want to invest in the gold and silver bull market, just get my bonus episodes. Just donate over $50 to my show through the PayPal link on my website, justinmooreshow.com. More is spelled M-O-H-R. Make sure you join Tom Woods' Liberty Classroom. And actually, Tom Woods is having a little contest now. So actually, yeah, if you guys help me, and you guys buy your Liberty Classroom subscriptions through me, hell, and let's just say this, because actually what Tom Woods is doing, he's giving away a car to his person who sells the most subscriptions, which who knows, there's probably people who are selling a ton of them, whatever. But heck, if I ended up somehow getting the car magically, let's just say if you guys help me get that or one of the cash prizes that he's offering, anyone who buys one of his little memberships to the Liberty Classroom, the $89 price tag. If you guys do that, heck, I'll just pay for your membership. How about that? So you have nothing to lose. I guess, no, you do have something to lose. You will have to pay if I don't win a cash prize or the car. So, but I guess it's not really losing from your perspective, because you're still getting Tom Woods' Liberty Classroom for $89. And look at what you have access to. 17 different classes that are taught there by some of the greatest professors out there. Dr. Robert Murphy teaches one. Tom Woods teaches one. Doug Casey on logic. Oh, man. So, I mean, it really is. It's a win-win for you guys. And I would. If I got one of those cash prices, anyone who signs up and purchases one of his Liberty Classroom memberships through the link on my website, I'll just pay for your membership. That won't be a problem. But for sure, what I will do, I will have a drawing for a silver coin, and you will get access, for anyone who buys through my link, you'll get access to my bonus episodes. So sign up for Tom Woods' Liberty Classroom. Just click on the little link on my website. That's all I have for you guys today. I thank you guys so much for being here, and I will talk with all you guys next week, and I'm looking forward to it. This is Justin Moore, signing off.